Okay, that's it. Huh?
Okay, let's continue. Since Abigail is on the call. So we said that it's all about monitoring, right? It's all about monitoring. And we see here that the board is really into monitoring. In addition, the board should also be accountable to the shareholders for its performance in carrying out these twin roles of decision-making and monitoring. So always remember the twin roles. If you don't even remember board of directors is what they do, always remember these twin roles, these twins. Decision-making and monitoring. Decision-making and monitoring. Decision-making and monitoring. It's very important. Okay. Now let's move on to the composition of and the size of the board. Composition and size of the board. The board is responsible for the long-term success of the company. The composition of the board of a major company in many countries consists of, there would be a chairman, who it's possible that the chairman may be an executive director, but it's more usually a non-executive director. We talked about non-executive director in our previous session. Number 2, a chief executive officer. A chief executive officer, or a CEO, or what people call MD. And this is the company's senior executive. The reason why it's called executive is you are involved in the day-to-day affairs of the company. If you are non-executive, you are not involved in the day-to-day affairs of the company. They have other executive directors and other NEDs. So this should be the composition of the board, right? You should have a mix of these people. It's always good to have NEDs because NEDs bring, or non-executive directors, I'll be using NEDs. The NEDs bring a lot more balance to the board structure. The board and its committee should have the appropriate balance of skills, experience, independence, and knowledge of the company. So that's how you balance out, your board, right? You should have the appropriate balance. It's like a football team. You can't go into a match and all your 11 players are strikers. Or you go into a football match and all your 11 players are midfielders. You can't do that. So your board should have an appropriate balance of skills, experience, independence, and knowledge. All directors should be able to allocate sufficient time to the company. They should be able to allocate sufficient time to the company. Time. A board of directors should be neither too big nor too small. If it is too big, it may become slow moving. If it is also too small, it may lack a sufficient range of skills and experience. So at this point, someone might be asking, so what is the ideal? What is the ideal? You are saying it should not be too big, it should not be too small. So I'll come there. The Code of Best Practices states that the size of the board should be arrived at with a view to promoting effectiveness and ensuring appropriate representational needs. The board represents the company. So that's what I mean by representational needs. It suggests that a board of between 8 and 16 directors for a listed company should be considered ideal. So when you have a board, and it's like the board is like a whole country. You know, that company, they can make decisions quickly. Between 8 and 16 should be fine. I would say somewhere around, just like a football team. If you have a board around 11 people, fantastic. You know, or 10 people, or like 12, you know, just like the disciples, something like that. 10 to 12, you are good to go. If you have too many, but the code of best practices, I think, suggests between 8 and 16. If you have too many, it's too much. It will slow you down. It will slow you down, and you'll not be able to make quicker, efficient decisions or effective decisions. Now, let's talk about appointments to the board. Appointments to the board. Appointments to the board are approved by the shareholders, and shareholders should be provided with biographical information of all individuals seeking appointment. Now, the code of best practices is telling us that there is no limit to the amount of directorships that any individual can hold. Right? There is no limit. Can hold a lot of directorships. But consideration has to be given to the obligations of the nominees, as well as the time they can devote as director. We don't want to give you a position that you don't have the time for. The code also states that all directors should submit themselves for re-election at regular intervals and at least every 3 years. So this 3-year principle, when I was working, it became, I heard it when I was working that, oh, you know, this director has been in this position for 3 years. So it's likely that after 3 years, he has to leave. I realized then that, oh, it's actually a principle in the code. And that's why it is so. So directors have to, they must submit themselves for re-election at regular intervals and at least every 3 years. Every 3 years. Executive and non-executive directors. So in case you couldn't join, what I usually say is that when it's getting to the exam, I see a lot of students join. It's called a student phenomenon. So around the precinct time, a lot of them will come. So hopefully, maybe we'll see that search. That's it. Executive directors are directors who also have what we call executive management responsibilities. And they are normally full-time employees. So people like the CFO, CTO, C110, CIO, all these people are what we call executive directors. Executive directors. You have the non-executive directors. We talked about them last week, but worthy of reinforcement, because when we are going through a case, right? When we are going through a case, we saw some of these things. You know, that's why I always recommend that you study with the past questions, because what happens is that when you are going through the past questions and now you are coming to read, you're coming to read the slides or read the book, the concepts will begin to come alive. So you would have seen something in the past question that you say, oh, I see it. Oh, okay, this is what they were referring to. Then because you have that reinforcement, it sticks faster. It sticks faster. Anyway, non-executive directors or NEDs are directors who do not have any executive management responsibilities in the company. They do not have any executive management responsibilities in the company. However, they might be an executive director in a different company. That's very, very possible. It's possible for someone to be an NED in one company and be an executive director in another company. They are also not employees of the company. They are not full-time too. They are not full-time. Before you appoint them, because they are not full-time, there has to be a clear understanding of how much time they are going to commit to your company's affairs. We need to be clear. We need to understand. The board of a large company consists of executive directors and non-executive directors. Non-executive directors are found on the boards of most stock market companies. The code of best practice 2 has also stated that there should be a finance director. Finance is a crucial part of every organization, and so there should be a finance director. There should be a finance director. There was one past question we looked at. I'm just wondering, was there a I can't even remember the details. Can't remember the details. But there probably was. Can't remember. For Customer Focus Limited, was there a finance director? Can't remember. I think so. Okay, any questions so far? Okay, Caleb.
Sir, in a previous lesson, when we were looking at the agency conflict, or the agency conflict, we looked at the situation where when the shareholders are fragmented, that means that there's no shareholder which has significant influence, or a shareholder that has is a majority shareholder. So when it comes to the appointment of the board, how are they going to be done? Because we also looked at that. Sometimes if the shareholders are fragmented, then the board tends to, put their interests before the shareholders' interest.
Okay, that's a good question. So you're asking, in cases where there's no clear majority shareholder, how do they appoint people to the board, right?
Yes, please.
Yeah, so it's like it will be like let's say we are in school, right? And we are trying to vote for the SRC board. This is just a hypothetical scenario. So this is how it will look like, because there's no clear majority, one majority person. This is how it will be like. So they'll vote. It's like we are in school and trying to vote for our SRC board. Our SRC board will consist of president, vice president, finance person, treasurer, whoever, marketing, I don't know, all kinds of positions. Let's say there are 5. And let's take the students as the shareholders. A lot of the students, they don't care, they won't vote. But if you look at the students, everyone has 1 vote. So whoever gets more votes will be appointed or will be approved. Will be approved, basically. So yeah, that's a hypothetical scenario. So the appointments to the board will be approved by the shareholders. I don't know if I answered your question. Maybe I didn't get your question right. Just let me know.
Yes, sir.
Yeah. Yeah, it's not exactly the same as the SRC one, but I just use that so that it could be a lot clearer to you. You know, it could be. It's just like how do you even say it? It's just like just think about it like you're the owner of a company. Let's say you, your brother, sister, your family, or let's say even this class, right? You guys own SWOT. Let's just say you own SWOT, right? So in terms of approving appointments to the board, let's say Lawrence and his team, they are the board. So you guys sit down and say, okay, Lawrence, is he good? Yes, he's good. You know, and you approve of him, and then he becomes part of the board. And so that's how it works. Just trying to bring the example home so that you can understand. I hope it's clear. Just now, if it's not clear, just let me know.
Yes, sir. Yes, sir.
Okay. Okay. Independence. Oops. What happened? It sounds like auditing or advanced audits, but we would see. As I go through strategic case study and audits, I see that if you take both papers at the same time, it will help you. Yeah. All directors, both executive and non-executive, should show independence of character. Independence of character. So what do they mean by independence of character? The board members should be able to hold their own views and express their own opinions with conviction. So you don't do what they call in entertainment fanfooling. So while you are sitting on the board, you don't just sit there and just agree with what one person is saying.
But don't try to bro. What's it?
Oops, sorry. Oops, what did I do? Okay, so you don't just go with what someone is saying, right? You should be independent on the board. That's how boards become better. But you know, the way human beings are, so it sounds nice in theory, but practically, sometimes that's not what happens. These characteristics of independence are mentioned in the Principles for Corporate Governance in the Commonwealth, which is called the CACG Principles. These state that the board should be composed of people of integrity who can bring a blend of knowledge, skills, objectivity, experience, and commitment to the board, which should be led by a capable chairman who brings out the best in each director. Crucial to this is having a proper director selection process to avoid the propensity for cronyism and tokenism. Cronyism. So we don't want, basically we don't want people who will just come and say what everyone else is saying. They can't express their own convictions. It's very, very important. Independent directors. Some non-executive directors may be classified as independent. An independent director is a director who has no link to a special interest group or stakeholder group, such as executive management, other employees of the company, a supplier or customer of the company. He has no link, so he's independent. Has no significant personal interest in the company. That's 2. Now, let me repeat again. An independent director is someone who has no link to a special interest group or stakeholder group. He has no link to a special interest group or stakeholder group and has no significant personal interests in the company. Given this definition of an independent director, it is impossible for an executive director to be independent. How many agree? How many agree? It is impossible for an executive director to be independent. And for those who are doing auditing, it is for this reason that's why we have to bring in an auditor to come and do the audits of their internal controls and financial statements. Because for this reason, an executive, the key word here is executive. The key word is what? Executive. I didn't say independent. We are not saying here that directors cannot be independent. You are saying executive directors cannot be independent. And that's why, for those who are doing auditing, that's why we bring in auditors. Because he or she has a direct link with executive management. Makes perfect sense. Only NEDs can be independent. Only NEDs have the possibility of being independent. But all you should know is that not all NEDs are independent. Or non-executive directors are independent. So there are situations where the NED has relationships with the company, or there are circumstances surrounding the NED that is likely to affect his or her judgment. His or her judgment. So basically, I wanted to talk about that so that you're aware. Oops. Okay. Still on. Any questions? Any questions? Slowly but surely we are getting there. I'm sure that the pre-sim, hopefully the pre-sim comes around the 17th or the 24th. Somewhere between that, it should show up. It should show up. The status of directors as independent or not independent may be significant for companies that are required to comply with a code of corporate governance. Now, as we've always indicated, there should be a suitable balance of power on the board. Very, very important. Now, it's important to know that in the UK, for example, right, this is just a test case when we are talking about balance of power on the board. A link between bad corporate governance and domination by a powerful individual. We said in our previous session that we don't want to have a board where it's dominated by one powerful individual. In the UK, for instance, bad corporate governance and domination by a powerful individual was evident in the case of the Maxwell Communications Corporation, which was headed by Robert Maxwell. It collapsed. That company collapsed unexpectedly in the early 1990s. It collapsed because of the same problem, right? Same problem. Definition of a suitable board balance. The Code of Best Practice has stated that at least 1/3 of the total membership of the board should consist of independent NEDs. So as you are going through your case, right, these are things that you should be looking out for. So the people's board, do they have NEDs? You know, you should be looking at the board. That's why on Customer Focus Limited, when we are looking at the owners or the directors, I was wondering whether one of them, forgotten his name, he seemed to be the most experienced. I was wondering whether in their meetings he will not exercise, he will not be dominant. You know, so those are things you should be thinking about, right? It's when you look at one person's experience and you look at their age and you look at maybe how much they're even contributing. If they're contributing like 70%, which I think was in the case of Customer Focus, I can't remember. But if they are contributing a lot in terms of equity capital, then they are probably going to be domineering. It's possible. I don't know. It's possible. So at least the code is saying at least 1/3 of the total membership of the board should consist of independent NEDs. In any event, there should be not less than 2 NEDs on the board. We also looked at another case by, I think it was a tourist company who specialized in bringing tourists from the USA to Ghana. And one of their founders was asking for them to bring an NED or some NEDs. And another of them suggested that, another founder suggested that, why don't we take one of the employees and make them that? Well, the question is that would they be independent that way? So that is their thinking. As you go through the text, and these concepts come alive when you go through the past questions. True and poor is definitely not for strategic case study. The code of best practices also suggests that listed companies should have a company secretary whose responsibilities include advice and guidance to the board chairman and the board on corporate governance matters. This company secretary obviously should be qualified. Hey, did I jump something? Okay, so let's move on to roles, remuneration, and disclosures. Still on governance. Roles, remuneration, and disclosures. Questions. Are you confused? Is it going well? What's happening? I believe all of you pass, to be honest. I believe all of you pass. You don't have a problem. You just have to put in the minimum efforts possible. I believe all of you pass. You just have to put in the work. Last sitting, it was fantastic. Last sitting was fantastic. Last sitting was amazing. I got nice notes from the students. So please, I'm sure you make SWAT proud. So we don't have a problem at all. I'm sure you make SWAT proud. So yeah, I believe in you guys. Just what the things I've said, the things I've said, just do them and you should be good to go. It's nothing scary. It's nothing scary. Yeah, if once you do the things I've told you, you get to the exam, you see that one. No matter how challenging it is, you still come out with a pass. Yeah. Last sitting I think was a bit challenging compared to last two. Last two sittings I thought was okay, but last sitting was quite challenging compared to last two sittings. And the students did amazingly well. Amazingly well. Yeah. amazingly well. Like, it was incredible. I had some of them sending me notes to say thank you, you know. Yeah, that is the students who remember. Those who don't remember, you too. They'll just leave your case for you. Separation of the roles of chairman and CEO. Separation of the roles of chairman and CEO. The two most powerful positions on the board of directors are those of the chairman, obviously, and the CEO or the MD. These roles may be held by two different individuals. On the other hand, they may be held by the same person. Now, if it's held by the same person, it's a problem. It's a problem. So when one individual holds the position of both chairman and MD, he may be in a position to dominate. So you see, that's the problem I was talking about. It's going to be a problem. A principle of good corporate governance is therefore that the two roles should be held by different individuals. To avoid the risk that one individual might dominate decision-making by the board, the UK Corporate Governance Code states that the roles of chairman and CEO should not be held by one person. The CEO should not go on to be the chairman of the company. No individual on the board should have unfettered powers of decision-making. Unfettered powers of decision-making. Unfettered powers of decision-making. Now, unfettered, no, it's a big English. So, who knows the meaning of unfettered? This one here is brofo. It means unrestricted, free. Like, no one is holding you. So, no individual on the board should have that kind of power. Like maybe, what's his name, Cry? Oh, this Nigerian dictator.
Abacha.
Sani Abacha. Or Idi Amin. No. It should. No individual on the board should have unfettered powers of decision making. Very, very important. Other internal stakeholders. In Ghana, however, the code of best practices does not go so far. Oh, the code states that ideally there should be a separation of the roles of chairman and MD, particularly in listed companies. So this was Ghana. We are being told in Ghana. Right. However, there may be a specific reason why the two roles should be combined. For example, in the case of a smaller company where the cost of separating the two roles cannot be justified on economic grounds. In the case of publicly listed companies, if the two roles are combined, the reason should be explained to shareholders, and the board should enact procedures to ensure the independence of the board as a whole. Although the code does not suggest how this should be done. So anytime I read this, I just wonder why the code is like that. Either you have, could this be a reason why our companies don't grow that much? Because you have a domineering individual on the board. And the other individuals on the board are just rubber stamp people who are just sitting there. At the end of the day, it's one person that takes the decision, they just move on. So could this be the reason why? I don't know. If the two roles are separated, their respective responsibilities should be formally defined so that it's clear who is responsible for which aspects of board business. Yeah, so the UK is a lot stricter because of, probably because one, it's an advanced system, and two, they realize how crushing it can be when you don't separate those two individuals. But in Ghana, it seems to be quite lax. And my question is why, but I don't think I'll get an answer. If anyone has an answer for me too, that would be amazing.
Well, we can say we've not had any big scandals which has led to such investigation or something like that.
I see. So we are waiting for big scandals, basically. We are waiting for them.
Not really, but that's most of these things were triggered by scandals. So
I see.
yeah.
I see. Ghana. Okay. Then hopefully. So right now, maybe we should, when we are doing our prayers, we should add that too, so that to change. Or we should just leave it like that. Let's just leave it like that. Yeah, maybe, I don't know, maybe in Ghana, there's nothing like that. You know, because in the US, when, okay, this is more of audits. When there were corporate scandals relating to audits, the Sarbanes-Oxley Act, they had to, you know, make things a lot more stricter. That's when they became a lot more stricter on internal controls. In the past, there was a focus on substantive testing. Anyway, sorry. This is a strategy class. The managing director, CEO, is responsible for the executive management of the company's operations. He is the leader of the management team, and all senior executives report to him. As I've already indicated, there should always be a finance director. CPEXam is very, very important. This means that the code recommends that a board of directors should have at least 2 executive directors, the MD and the finance director. Now let's look at the role of the board chairman. This board chairman, what does he do? What does he do that we have to, one human being has to be doing it? In many global public companies, the role of the chairman is part-time, which is true. You know, it's not a full-time thing. They do it part-time. Now, we are going back to the UK. The UK Corporate Governance Code states that on appointment to the position, the chairman should be independent. If companies comply with the UK code, a chairman will therefore be both independent and non-executive. However, this is not necessarily a requirement of good governance, and the chairman may work full-time for the company. So it's possible that the chairman would be full-time or part-time, but usually what I've seen is that they are part-time people. They're usually very, very kind of like busy people, and they do this part-time. And they are experienced, very, very experienced people. The board chairman or company chairman is the leader of the board of directors. He or she is responsible for managing the board. Whereas the CEO is responsible for managing the company, the board chairman is responsible for managing the board. Now, let's talk about the functions of the chairman. The Code of Best Practices in Corporate Governance comments that the chairman plays a crucial role in ensuring good corporate governance and should ensure that the board is in complete control of the company's affairs and fully alert to the obligations to the shareholders, industry, and the law. It specifies that the chairman should be expected to, number 1, he is the one responsible to ensure that the board meets regularly. The board, he's a manager of